What's up YouTube? Dougie Chong here. Welcome to today's video where we'll be going over if an RRSP is worth it or not. I'm back to doing real videos now. I'm out of AI credits. I'll try to do a mix of both AI and real videos. Had a bit of a mixed reaction to AI videos. In this video, I'll be briefly going over what an RRSP is and if it is worth it for you. I'm super excited for this video. I did a lot of calculations for it, so let's get started. First off, what is an RRSP? Stands for Registered Retirement Savings Plan. Sometimes it's just called an RRSP or Retirement Savings Plan. It's a retirement savings account that you open with a bank, credit union, or online broker, and it's officially registered with the Canada Revenue Agency, the CRA. The key idea, you put money in now, you get a tax cut right now, and then it grows tax sheltered in the RRSP, and then you get tax on it when you take the money out. So compared to a normal non-registered account, you're getting two main perks. One, an upfront tax deduction, and two, tax sheltered growth. That's why I like to call this a tax deferred account, and unlike a TFSA, which you should always maximize right away, it's not always so straightforward with an RRSP. Let's talk about the main strategy with an RRSP and how it is marketed to most people. Lower taxable income can lower your tax bracket, or at least reduce the amount of tax you have to pay in a year. So when tax season comes, everybody is usually excited to put that RRSP in and see their tax deduction come out. So suppose you made $100,000 in a year and you contributed $20K to your RRSP. You would only pay tax on that $80,000. People see this instant savings and blindly max out their RRSPs, especially high income earners. However, a very important aspect that needs to be factored in is what your expected tax bracket is going to be when you take the money out. Because this money will be fully taxed as income, whereas if you had just put it in a non-registered account, only 50% of it would be taxed as capital gains. That's why for high income earners with a defined benefits pension plan, it's not a good idea to have a very high RRSP. This is because you will never have years of low or no income, and you will be taxed very heavily on the withdrawals of this RRSP. I've seen this happen many times, so it's important to think about your retirement plan even if you're 10 or 15 years away from retirement. Okay, let's get into some nitty-gritty here. How much can you actually contribute into an RRSP? There are limits, and this is where people get nervous, but it's really not that scary. Your RRSP contribution room is based on your income from the previous year, and it adjusts a little bit depending on what kind of pension you have. In general, the RRSP calculates your contribution room as 18% of your income, or a fixed amount depending on which is lower. It's important to note that they also add unused contribution room from previous years. For 2025, the maximum RRSP contribution was around $34,000, but most people will get capped at the 18% limit. A lot of high income earners will just blindly max out their RRSP. Since they make so much money, they don't really know what else to put it in. But later on in this video, we'll discuss why this might not be the best option. You can also find your exact contribution limit on the CRA website. Deadline-wise, contributions in the first 60 days of the year, that's usually around January, February, can be used to deduct taxes for the previous year. This is really helpful if you don't know exactly how much money you were going to earn in a year. Maybe you earned a lot or a lot more than you thought you would. And then in those first January, February, you can decide if you want to contribute to your RRSP, if you have enough space, if you're not going to be too strapped for cash, then you can make a contribution and get some tax deductions. Another thing to note, you can contribute to your RRSP up until December 31st of the year you turn 71. Afterwards, it gets turned to an RRIF and you'll be forced to withdraw from the account. One important warning, if you contribute more than your RRSP limit, or they actually give you a $2,000 cushion, then you'll be charged a 2% penalty, which is pretty substantial, and you should just Don't try to guess it, just check your actual limit. Sorry, not 2%, it's actually a 1% per month penalty. One small note, I won't go into too much detail here, but if you're deciding between contributing to your RRSP versus your TFSA, always do your TFSA first. Now let's talk about where RRSPs shine. So RRSPs are retirement accounts. They're mainly used when the goal is a long-term savings account, not for short-term goals. This allows the account to grow and compound tax-free over a lengthy period of time. Big win number 1, you're in a relatively high bracket now and you expect to be in a relatively low bracket later. That difference is going to be your gain, and your investments grow tax-free the entire time. Many Canadians see their peak earning years in the 40s and 50s, and then they see their earnings drop off when they start taking things like CPP, RRSP withdrawals, and other things such as OAS. That's exactly the scenario that RRSPs are designed for. If you're not at least in the top 3 income brackets, I generally don't recommend investing in RRSPs since the savings is not going to be that much. Big win number 2, sometimes employers will match your RRSP contributions. So for example, if you contribute 3% to an RRSP, sometimes an employer will also match that 3%. This is a rare exception where even if you're in a lower income bracket, I would do this. When I worked at Amazon, I always did the 3% match. It's free money. This is a no-brainer. You always take this money. But in addition to this 3%, I also decided to put a little bit more in RRSP. I didn't max it out, but I'll go over exactly what I did later on in this video. Big win number 3. If you want some discipline, maybe you spend a lot, you gamble, you always use your extra money, because there's a penalty for withdrawing early from your RRSP, it incentivizes you to keep it in the account. So if you don't have the discipline to invest the money you would have put in your RRSP in a regular account, maybe an RRSP is a good idea for you. Alright, now I'll share a spreadsheet that took more time than I thought to put together, even though I used AI to make it and it generally did a pretty good job. So in this spreadsheet, I'll be comparing an RRSP account plus investing the tax savings in a non-registered account versus just investing in a non-registered account. I have a lot of variables at the top, assuming 10K annual contribution. It assumes 30 working years and 25 retirement years. An expected annual rate of return of 10%, which I found actually doesn't change the difference between the accounts because they both grow at the same estimated rate. The key change is marginal tax rate during working years and tax rate when you are withdrawing from the RRSP. The interesting I found is that if you are in the exact same bracket, the math works out that you would have the same amount at the end of the 55 years. An important thing to note is in each tax year, tax is not deducted from the non-registered accounts. It is assumed that the assets being invested in only provide unrealized capital gains. If you want to buy something like dividend stocks, it could make sense to put those in your RRSP. Going through each of the 55 years, I track the RRSP contribution. I track the RRSP tax refund. I track the current RRSP balance. I track the RRSP withdrawal, the tax on the withdrawal, the net RRSP withdrawal, the refund invested into the non-registered account, the non-registered account balance, the non-registered account adjusted cost basis, and then column L here, this is if we didn't use our RRSP, if we just put all that 10,000 into a non-registered account. This is the separate non-registered account balance. And this is the non-registered account book value. So I went over the formulas I'm hovering over each cell so you can take a look if you want to see what the exact formulas are. But basically it goes through all 55 of the years. In this example, after the 55 years, the RRSP will be completely drained and you have $19.6 million in the non-registered account. The non-registered account only will also have $19.6 million. The first thing to note is that these numbers are absolutely massive. So just a $10,000 investment a year would yield this insane number. So I don't know who would max out at 30K per year. The maximum just doesn't make too much sense in my opinion. Maybe if you only intended to work 3 or 4 years, it might make sense to contribute at that maximum. Of course, this is assuming a generous rate of return of 10%, but this is definitely achievable and is the rate of return for the S&P 500. A slightly lower rate would still yield quite a high number. You might be thinking, how could such a small numbers generate such a high amount? The key is compounding. In this example, the user had 55 years to accumulate wealth, which is not uncommon to a typical career path. Looking at these two scenarios, you might think it's okay to invest in the RRSP since it turned out about the same. The key issue is that the assumed tax bracket at which the RRSP is withdrawn at was 40%. Modifying the spreadsheet to get the exact tax amount would have been a little too much work for me, but the main takeaway looking at the spreadsheet is that there will be some massive RRSP withdrawals. Let's go here. 250K all the way up to $700,000, which would be the withdrawals at the highest tax bracket. Since I already shared that the key difference is the tax bracket you are in, the non-registered account only would be better in this example. So I'd have to tweak my spreadsheet to take into account income brackets to get the exact break-even point. But my rule of thumb is to not let the RRSP grow to an unwieldy amount like $19.6 million. Who knows, you might invest in the next NVIDIA or AI stock and you could grow to that amount, but generally I think like a 500 to 600K RRSP when you're retired is a good amount. You can make healthy withdrawals from that and deplete it without being in such a high tax bracket. Keep in mind you will most likely have CPP and OAS payments as well, so that counts in factoring in what income bracket you'll be in. And if you plan on never retiring and you'll always be in a high income bracket, then the RRSP is not really a good account for you since you'll just have to pay the tax later. I'll leave a growth calculator down in the description below where you can do your own calculations for a non-registered account similar to what I did. You can change your rates of return, your number of years, and even account for inflation. That's it for this video, guys. Hope you enjoyed it. Don't forget to leave a like and subscribe if this video helped you at all. And if you made it this far in the video, I'd like to hear your RRSP scenarios if you're willing to share in the comments below. Enjoy the rest of your day and see you in the next video.